Most people don't realise how much tax they pay inside super. Right now I'm going to show you how tax on superannuation is calculated and what you can do to reduce it to zero. Hi there, I'm Chris Strano, the founder of SUPERGUY, the place where Australians go to maximise their super and build their own retirement plan. If you're new here, make sure you click that subscribe button and all the links related to this video. Remember, this is general advice only. Please read the disclaimer below this video. Let's dive in. Do you know how your super is taxed? Let's take a look. Aside from a mandatory savings platform for employees, the whole purpose of superannuation is to provide you with financial incentives to save towards your own retirement, with the intention that we as a society are less reliant on social security once we cease work. So what are the incentives? Well, the incentives of adding to our super come in the form of tax concessions. Basically, the government is saying if you invest in super instead of your own name, we'll make sure that you pay less tax, with the only real catch being that you can't access it until you reach a certain age. So what are the tax concessions? Well, let's begin with contributions. If you contribute to super with money you've already paid tax on, it'll enter super tax-free. This is called a non-concessional contribution or after-tax contribution. It has 0% contributions tax. If you contribute to super with pre-tax money like salary sacrifice or personal deductible contributions, it is referred to as a concessional contribution, and contributions tax of 15% is deducted from the contribution amount and the remainder is added to your account balance. But this 15% is usually less than the tax that you would pay if you took this portion of your income as a wage instead of salary sacrificing, or if you didn't receive a tax deduction for making the deductible contribution. Does that make sense? For example, salary sacrificing, say $10,000 over the course of a year into super would result in contributions tax of $1,500, which is 15% of $10,000, and the remaining $8,500 would be added to your account balance. But because you've salary sacrificed it, this $10,000 is not taxed at your marginal tax rate, which is probably going to be higher than 15%, so you've reduced your tax. Employer contributions such as SG contributions are also classified as concessional contributions because your employer claims a tax deduction for making them, and therefore they incur contributions tax also. Very high income earners are slugged with an additional 15% contributions tax on all concessional contributions, but this is still generally lower than their individual tax rate. So that covers tax on contributions, 0% on non-concessional and 15% on concessional or deductible contributions. What other tax concessions does super give us? Well, when your super balance is invested, it earns income such as dividends, interest, distributions, rent, etc. And all of this income is taxed at only 15%, compared to being taxed at your marginal tax rate if you own the investment in your own name. Capital gains tax within super is also only 15%, reducing to 10% if you own the asset for longer than 12 months. Again, this is often lower than paying capital gains tax in your own name. So now you might begin to see the benefits of making non-concessional contributions to super. A non-concessional contribution does not provide you with a personal tax deduction or reduce your income tax, but it does allow you to invest in super, which taxes earnings at a maximum of 15%, compared to being taxed at your marginal tax rates. And finally, once you convert your super to pension phase, when you retire and start a retirement income stream, your balance remains invested and all income derived from investments are received completely tax-free. So too are capital gains. This means that you pay absolutely no tax on any investment earnings. So you get the tax benefits for contributing to super and you get the tax concessions on investment earnings within super. This incentivizes you to contribute to super while you are working. Then, in order to encourage you to keep your retirement savings inside super once you do retire, all investment earnings are tax-free. Not bad if you ask me. Check out this chart. This is a 50-year-old with an average personal tax rate of 30%, saving $1,000 per month and then retiring at age 65. It compares investing this $1,000 per month and earning a return of 5% per annum in their own name versus contributing it to super as a deductible contribution and investing it within there. From only investing $1,000 per month, the tax benefit alone provided by Super over this 15-year period is a whopping $62,000. So there you have it. If you learned something new from this video, make sure you subscribe to my channel for more videos just like this. If you want more exclusive superannuation tips, head over to superguy.com.au and sign up for my newsletter for free. Also, we have plenty more videos on superannuation and retirement planning in the Superguy Hub, including stacks of tutorials, super strategies and case studies to help boost your super and plan your own retirement. Go to superguyhub.com.au, the link is in the description. Thanks for watching and I'll see you on the next one.